Most people believe investing is only for the rich. They think you need thousands of dollars, insider knowledge, or a finance degree to even start. But what if I told you that belief is the exact reason most people stay broke? What if the real problem is not how much money you have, but how long you wait? Today we're answering one simple but powerful question. How much money do you really need to invest to start? And the answer might completely change the way you think about money. Let's be honest for a moment. If you ask 10 people why they haven't started investing, you'll hear the same excuse again and again. I don't have enough money. But here's the truth no one tells you. Waiting to have enough money is one of the biggest financial mistakes you can make, because investing is not about starting big. Investing is about starting early and consistently. Think about this. Every single investor you admire, whether it's Warren Buffett or an average millionaire next door, all started at zero. None of them woke up one day with a perfect amount of money and perfect timing. They started with what they had, learned along the way, and let time do the heavy lifting. The real question is not how much do I need? The real question is how soon can I start? In this video, we're not going to talk theory. We're going to talk reality. We'll break down exactly how much money you need based on different situations. Whether you have just a few dollars, a stable income, or absolutely no savings right now, you'll know where you stand by the end. And more importantly, you'll know your next step. Before we talk numbers, you need to understand one mindset shift. Investing is not a one-time action. It's a habit. Just like going to the gym. Results don't come from one heavy workout. They come from showing up again and again. Even a small amount invested regularly can outperform a large amount invested late. So, if you've been waiting for the right time or the right amount, this video is for you. Because the truth is, the best time to start investing was years ago. The second best time is today. Now let's break it down step by step and answer the question everyone is asking. What is the minimum money you actually need to start investing?
Now let's talk about numbers, because this is where most people get confused. When someone hears the word investing, they imagine huge amounts of money. But in reality, the minimum amount you need to start investing depends on where and how you invest. And for most beginners, the number is much smaller than you think. If you are living in the USA or targeting USA-based platforms, the truth is you can start investing with as little as $1. Yes, $1. Many modern investing apps allow fractional investing, which means you don't have to buy a full stock. You can buy a small piece of companies like Apple, Google, or Amazon. This completely removes the old barrier that investing is only for people with thousands of dollars. But here's something important. Just because you can start with $1 doesn't mean that amount will change your life overnight. The purpose of starting small is not instant profit. The purpose is building the habit, understanding the market, and training your mindset to think like an investor, not a spender. Let's break it into simple levels so you can clearly understand where you fit. If you have zero savings right now, your investment amount is not money, it's knowledge. Your first investment should be learning how money works, how markets move, and how emotions affect decisions. Even watching finance videos, reading articles, or using free tools is a form of investing, because the biggest risk at this stage is not losing money, it's making ignorant decisions later. If you can save $10 to $50 per month, you are already ahead of most people. This amount is perfect for beginners. With this, you can invest in low-cost index funds or ETFs that track the overall market. You're not betting on one company, you're betting on the growth of the entire economy. Over time, this simple strategy beats most people who try to be smart and pick stocks. If you can invest $100 to $300 per month, now you are playing a serious game. At this level, consistency matters more than strategy. Investing this amount monthly for years can build real wealth, not because the amount is huge, but because time and compounding start working in your favor. This is where investing turns from a side habit into a wealth-building system. Now let me make one thing very clear. The biggest mistake beginners make is asking how much money can I invest one time instead of asking how much can I invest every month. One-time investing is luck-based. Monthly investing is system-based. Wealth is built through systems, not motivation. Another important point most people ignore is risk. The less money you have, the more careful you should be. Starting small protects you from emotional mistakes. When people invest big amounts without experience, fear and greed take control. They panic when the market falls and get excited when it rises. Small investments give you real experience without destroying your confidence. So when someone asks, how much money do I need to invest to start? The honest answer is this. You need enough to start learning, enough to stay consistent, and enough to sleep peacefully at night. If investing makes you stressed, you started with too much.
Now this is the question that confuses almost everyone. Should you save first or should you invest first? Most people think the answer is simple, but the truth is more practical and more powerful than you expect. Let's clear one big myth right now. Investing without any savings is like driving a car without brakes. You might move fast, but one small problem can destroy everything. That's why before talking about investing seriously, you need a basic financial safety net. This doesn't mean you need a huge emergency fund. You don't need 6 months of expenses right away. That idea scares beginners and delays action. What you actually need is enough savings to handle small emergencies so you don't panic and pull your investments out at the worst time. Here's the simple rule. If you don't have at least 1 month of basic expenses saved, your first focus should be saving, not investing aggressively. Why? Because life is unpredictable. A medical bill, job issue, or family expense can force you to sell investments at a loss, and that one mistake can mentally push you away from investing forever. But here's the smart part most people miss. Saving and investing are not enemies. You don't have to choose only one. You can do both at the same time, even with small amounts. This is called balanced money behavior, and it's how financially smart people operate. For example, if you can save $100 per month, don't put all of it into savings. You can split it. Put $60 into savings to build safety and $40 into investments to build growth. This way, you're protecting yourself while still letting your money work for you. Now let's talk about people who say, I'll invest after I save enough. The problem with this thinking is that enough never comes. Expenses increase, lifestyle changes, and fear grows. Years pass and you're still waiting. That's why starting small investments early is so powerful. It builds confidence, not just returns. Another important point is inflation. Money sitting in savings loses value over time. Your bank balance might look safe, but its purchasing power is slowly shrinking. Investing is how you fight inflation. Saving is about safety. Investing is about growth. You need both to win long term. So the real answer is not save first or invest first. The real answer is stabilize first, then grow continuously. Build a small safety net, then invest consistently. This order keeps you calm during market ups and downs and helps you stay invested long enough to see real results. In the next part, we'll talk about the biggest silent killer of beginner investors. It's not lack of money. It's not market crashes. It's something much more dangerous, and most people don't even realize it until it's too late.
Here's the harsh truth that nobody talks about. The biggest reason beginner investors fail is inaction, not lack of money, not the stock market crashing, not even bad advice. It's doing nothing, waiting for the perfect time or perfect amount to start. That's the silent killer, and it kills more potential wealth than any market crash ever could. Think about it. Every day you wait, you lose the most powerful tool in investing, time. Even if you invest just $50 today instead of waiting to save $500, the time your money has to grow compounds exponentially. One small investment started today often beats a large investment started years later. Compounding doesn't care about your excuses. It only cares about your consistency. Another silent killer is overthinking. Beginners spend weeks, months, even years researching every stock, every fund, every strategy. And then what happens? Nothing. Money sits idle in a bank account, losing value to inflation while opportunities pass by. Remember, perfect investing doesn't exist. Smart investing exists. And smart investing is taking action, learning as you go, and adjusting along the way. Here's a simple truth. Starting is more important than starting big. Small, consistent investments teach you lessons you can't get from videos, courses, or advice. How to handle market drops, how to stay calm during volatility, and how to manage emotions. These lessons are worth more than any dollar amount you invest. And here's a tip most people ignore. Automate your investments. Set up even the smallest monthly contribution to a brokerage or investment app. Make it automatic. This removes hesitation, removes emotion, and makes investing a habit. Habits, not motivation, create wealth. Motivation fades, habits last. Finally, remember this. The first dollar you invest is not just money, it's experience. It's a lesson in patience, discipline, and long-term thinking. That first small investment is more valuable than many people's first large investment because it teaches you how to do it right without fear. In the next part, we'll break down exactly how to start with as little as $1 and build a system that grows into real wealth over time. You'll see how beginners can start small but think big, and why this approach beats waiting for the right moment.
Now, let's get practical. Many beginners think they need hundreds or thousands of dollars to even open an investment account. That's completely completely outdated thinking. Today, with modern platforms and apps, you can start investing with as little as $1 and still set yourself up for long-term growth. The first step is choosing the right platform. There are apps and brokerages designed specifically for beginners, which allow fractional shares, low fees, and automatic investing. This means you can buy a portion of a stock or fund instead of waiting to afford a full share. For example, if one share of a company costs $500, you don't need to wait until you have $500. You can start with $1, $5, or $10. Next, focus on low-cost index funds or ETFs. Why? Because these investments spread your money across hundreds or even thousands of companies. You're not betting everything on a single stock. You're betting on the growth of the entire economy. This reduces risk and allows even tiny investments to grow steadily over time. The third step is consistency. $1 today isn't life-changing, but $1 every week, month, or paycheck adds up over time. For example, if you invest $5 per week in an ETF that grows at an average of 7% annually, in 10 years, you'll have a significant amount, not because the initial money was large, but because you started early and let time do its work. Automation is key. Set up automatic contributions so you don't have to think about it. This turns investing from a decision into a habit. Habits compound just like money. You'll start to see that your investments grow even while you sleep, and more importantly, you'll develop the mindset of an investor instead of a spender. Finally, remember this golden rule. Start small, think big. The size of your first investment doesn't determine your future wealth. The habit of investing consistently does. By starting with even $1, you are training yourself to think long-term, manage your emotions, and stay disciplined. These are the real skills that turn beginners into successful investors. Now that you know how to start with as little as $1, let's talk about the next step, how to turn small investments into serious wealth over time. This is where most beginners fail. They start, but then they give up too soon or expect instant results. Real wealth is built slowly, methodically, and consistently. The first secret is time and compounding. Compounding is the magic that turns even tiny investments into substantial amounts over years. Let's say you start investing $10 per week at an average annual return of 8%. After 10 years, you won't just have your total contributions, you'll have thousands more from growth alone. The key is that your money starts working for you before you even notice. The earlier you start, the more powerful compounding becomes. Second, always reinforce your investing habit. This means increasing your contributions gradually whenever possible. Even a small raise at work or extra income from a side hustle should go into your investments. Don't spend all extra money on short-term pleasures. Instead, let it fuel your long-term growth. This is how ordinary people create extraordinary results over time. Third, never stop learning. Small investors who grow into big investors are constantly improving their knowledge. They read books, watch educational videos, follow market trends, and learn from mistakes. Knowledge compounds too. It prevents you from making costly errors and helps you make smarter decisions as your portfolio grows. Fourth, focus on low-cost investments. High fees destroy compounding power. Choose index funds, ETFs, or fractional shares with minimal fees. The lower your costs, the more your money grows. Many beginners overlook this and lose thousands over years without realizing it. Finally, mindset is everything. Don't measure success by short-term gains. Measure it by consistency, discipline, and patience. Wealth is a marathon, not a sprint. Investors who panic during market drops or chase hype never see the full power of compounding. Those who stay calm, invest regularly, and think long-term are the ones who create financial freedom. Remember, small steps taken consistently are better than giant leaps taken sporadically. Even if you start with $1, that first step puts you ahead of millions who never start at all. The combination of time, consistency, and smart choices turns tiny investments into life-changing wealth.